For this video, we will talk about how to use this net present value rule to pick the most profitable or most promising investment projects. Remember, we have been talking about the decisions of business managers. They make decisions related to the real assets in a corporation. And for these kind of decisions, we say it is capital budgeting decisions. And in previous lectures, we introduced how to calculate the time value of money to calculate the net present value from cash flows over time. And for this lecture, we will use this method to evaluate the different opportunities or different alternatives in these capital budgeting decisions. And we try to pick the project for the business manager. For a firm, it wants to pursue a project based on whether or not this project meets the objective of maximizing the firm value or maximizing the benefit of shareholders. So here is an example for a capital budgeting decision as the business manager. Here we have this project. This investment project requires you to pay $150,000 in year 0. And 1 year later, you will receive $50,000. 2 years later, you will receive $70,000. And 3 years later, you will receive $90,000. So the main characteristics of this investment project is that we have different amount of cash flows over the time horizon. And we introduce how to calculate time value of money. So now if we know the discount rate, or we say the required return is 12%, we use this required return to calculate the time value of each cash flow. And then we calculate the combined present value of all 4 cash flows. Generally, we have these steps in doing this capital budgeting decision. First, we estimate the cash flow at different time points. For a manager in a firm, this would be the most difficult step. And second step is to select an appropriate opportunity cost of capital. Later, we will talk a lot of details about this WACC, this opportunity cost for firms to do this financing. And in the third step, we apply an evaluation technique. When we talk about evaluation technique, we are talking about different criteria in picking these projects. And in the first step, we determine the selected project and we implement this investment project. For this lecture, we focus on the third step, and we try to compare different evaluation techniques. We have common methods to evaluate capital budgeting alternatives. The best evaluation method is to calculate the net present value of different investment opportunities, and then we pick the one with the highest net present value. Alternatively, we have choice in using the internal rate of return. So we are trying to say that an investment project, we have inflows equals to outflows if we choose the correct discount rate. And we say the correct discount rate as the internal rate of return. In addition, if we consider we can use the positive cash flow from a investment project to make an investment in risk-free asset. Say we can use the positive cash flow, the revenue flow from an investment, and use this money to make an investment in government bond. Then we are saying we are calculating the modified internal rate of return. And alternatively, if we have focused on the term structure of the cash flows of an investment project, then we use the rule of payback. Or in some situations, we are constrained by the money in hand. Then we use this profitability index to pick the project. First, let's talk about the net present value rule. The net present value is the present value of all the cash flows of an investment project. And we discount these cash flows with an appropriate opportunity cost of capital, or we say we choose an appropriate discount rate. So we can summarize the NPV method in 2 steps. The first step is to estimate cash flow at each time point, then pick an appropriate opportunity cost of capital, and discount the cash flows at all the time points. And then we select the project with positive net present value. The net present value method can be applied to projects with different time length. Whether it is a 3 years project or 30 years project, we can always use this net present value method. And in previous lectures, we already studied many useful equations to calculating the time value of cash flows. For example, we know the equations in calculating the present value of annuities and the present value of growing perpetuities. I want to emphasize here, when we select the project with positive net present value, the net present value is calculated at year 0, or we say it is net present value today. But at different time points over the time horizon, we may have positive cash flow or negative cash flow. So the positive net present value may not equivalent to positive cash flows at every time point.